Greetings everybody, welcome back to Accounting 1101 where we have been diligently working through the topic of inventory, and we're kind of wrapping up one set of topics about inventory right now with our video, and then we'll come back with another set where we talk about valuing inventory. And so we're not quite done yet, but we're kind of wrapping up one area again, the basics of inventory. We've talked about purchasing inventory, we've talked about selling inventory, we've talked about shipping cost, and so we're kind of getting the basics down before we move into the valuation part, which can be a little bit complicated. In our final video, in the first part of topics we're talking about shrinkage, and no, I'm not talking about the old Seinfeld episode with Costanza, I was in the pool. We're talking about inventory shrinkage and how to make the adjustment from an accounting standpoint when our inventory just disappears. Now, we've talked about the perpetual inventory system and how a lot of the places that deal with big amounts of inventory use a perpetual system that continually updates. It updates the inventory when we buy inventory. It updates the inventory balance when we sell inventory, all through the magic of barcodes and scanners and computer information systems. So you would think that because we're using the computers, because we're scanning the inventory when we get it, because we're scanning it again when we sell it, that the inventory balance would always be correct. We use a perpetual inventory system. So our accounting balance for inventory is always correct, right? Right? Unfortunately, that's not the reality of the situation. You may have heard in the news about a thing called inventory shrink, when inventory just kind of disappears. We don't know where it went. Maybe it was shoplifting. Maybe it was theft from an employee. Heck, maybe it was just an error. I ordered last year, my kiddo went into junior high, it was 2 years ago. My kiddo went into junior high and needed a lock for her locker, a little padlock. So I got on Amazon and I ordered a beautiful purple padlock, master lock, with the combination on the front. And I ordered one of them. And I waited patiently. 2 or 3 days later, here comes the box, and I'm trying to figure out why Amazon sent me a box that was literally this big for one padlock, because that was all I ordered. I opened up the box, and there was 10 padlocks in it. They sent me literally a case of padlocks, even though I ordered one. And so I did what any responsible parent would do. I sent my kid to school with 10 padlocks and told her to sell them for $5 a pop. Teaching entrepreneurship here, right? No, I didn't do that. I sent them back. But that was an inventory error. They sent me more than they should have. If I would have kept it, well, that would have been bad for them, and they would have experienced inventory shrink of 9 padlocks. As I said, the reality is what is on the computer printout for inventory, what's in the computer system, is always going to be greater than what's on hand, because inventory just has a way of walking out the door. So let's do an example. Big Box Incorporated had the following inventory balance on December 31. Per the computer, they had $63,950. That was in the accounting records for the account balance. In other words, what the computer showed is the value of inventory. But when it was counted physically, someone went out and counted it, we counted $62,150 worth of inventory. Computer says one thing, reality in our count says another. So we have shrinking going on. We calculate the amount, we take the computer amount, we subtract out the physical count, we got 1,800. Poof, gone. Who knows where it went? We're not worried about that part right now. We just have to make an accounting entry to reflect the fact that $1,800 worth of inventory has grown legs and walked out of the store. We make an entry to record the shrink. We debit cost of goods sold, $1,800. We credit inventory, $1,800. Now, the important thing about this inventory, you need to understand, everybody, we're making inventory go down to reflect the fact that that inventory has disappeared. We're recording it as an expense as well. It's a cost of doing business. We're just adding it to cost of goods sold. So the kind of interesting thing about cost of goods sold, it's not just the cost of goods that we sold, it's the cost of goods that have also disappeared. We can't just lump it all into one account there. We don't know whether it's sold, we don't know whether it's disappeared. We just know it's gone and we don't have it anymore. So cost of goods sold, that expense account is going to carry the cost of shrink as well as the cost of goods that we actually sold. Big issue in retail right now. And I've been reading that with a lot of the CFO comments that are being made on earnings calls, that people are kind of getting the impression that shrink is at the maximum level right now. It's going to start coming down. But you look at annual reports, you look at quarterly reports where they're talking about this kind of stuff, it's a big deal. This is Target's quarterly report, their 2023 10Q from Q1, quarter one. Talks about the business environment. We continue to experience higher inventory shrink as a percentage of sales. So maybe shrink, it doesn't say what the percentage of sales is. Maybe shrink is 1%, 0.5%, 3%. We don't know. It doesn't say. They just say that it is higher than normal relative to where it's been in the past, including significantly higher shrink rates at certain stores. If you go to the Target in Beaver Creek, if you go to the Target in South Lebanon, if you go to the Target anywhere, any Target location, somewhere, they've calculated the shrink rate for that store. Some locations are going to have higher rates of shrink than others due to all kinds of different factors. We believe that this trend is pervasive across the retail industry. It's not a Target problem. It's a Target problem. It's a Walmart problem. It's a Big Lots problem. It's a Walgreens problem. It's a CVS problem. Every retailer is dealing with this, and it seems to have kind of exacerbated since the COVID pandemic for some reason. We can continue on here. Increased shrink has had and will continue to have an adverse impact on our results of operations. Meaning, when you talk about results of operations, you're talking about the profitability on that income statement. You think back to your income statement for a retailer. Net sales or revenue minus cost of goods sold is gross profit. Then all your other expenses is net income. If we're running shrink and accounting for it through cost of goods sold, we're raising that expense, which is going to lower our gross profit and our net income. So that's what that's saying right there. Every time you see on the news a story about shrink, or you see people on social media stealing from a retailer, that eventually ends up impacting the bottom line in a very negative fashion. So, inventory shrink, a very real issue, very easy to account for as far as a journal entry. Coming up with the number, probably a little bit more difficult, but the actual entry, pretty easy to understand and record. You're going to have to make a few entries regarding inventory shrink in your homework as you're taking a look at those. If you have any questions, I'd be happy to help. As always, feel free to reach out to me. Next set of videos dealing with inventory, we're going to talk about valuation. How do we value inventory after we bought it and it's been sitting on the shelf? How do we come up with that cost of goods sold number that's been given to you and all the problems up to now? How do we come up with the value for ending inventory? I'll introduce a thing called FIFO and LIFO. It's going to be fun, so stick around so you can learn all about FIFO and LIFO. We hope to see you back for that. Until then, take care, everybody.